Have you ever felt lost in the sheer volume of market information? I used to at one point. In today's crazy markets, we are constantly bombarded with data, opinions, and news, not just from financial media, but even more intensely from social media, influencers, everyone else. If you're new to markets, it becomes even more difficult because there's way too much noise, and to figure out what truly matters in trading is quite hard. It's easy to get caught up with random reels, tweets, or even daily headlines, and we end up reacting impulsively. But being good at trading isn't about haphazardly reacting. It's more about building a framework of sorts to figure out what's happening in the market and use that framework as a tool to decide when to react. Hello people, I'm Sandeep Rao, a SEBI Registered Research Analyst, and in this video we're going to shift our focus from daily distractions to something far more useful, and that's consistent weekly analysis of the markets. I'm going to share with you a few essential market metrics when tracked diligently every week can provide you with a powerful edge. When I talk about framework, an analogy comes to my mind. Let's say you want to understand the seasons better, and at home you have a window that opens into a park or a forest or something like that. Now you have a choice to draw the curtains and ignore everything altogether, but let's assume you don't do that, okay? So you also have a choice to open the window and observe what happens. Maybe you would see blooming flowers, the shifting of wind patterns, the angle of the sunlight, the habits of the birds, all of that. And when you observe this day after day, at some point it starts to give you a sense of the seasons. Likewise, by observing a set of market metrics week after week, we develop this sense-making ability in the context of markets. Now back to key metrics. The metrics that we are going to talk about in this video aren't some random numbers. They are key indicators that reveal the health, sentiment, and potential direction of the market. By incorporating these into your routine, you'll gain clarity, make more informed decisions, and ultimately be able to create a set of robust trading strategies. So let's dive in and explore these key market metrics. First things first, a quick note on the indices that we will be tracking. Our focus will primarily be on Nifty 50, Bank Nifty, Mid Select, and Sensex. We've selected these four based on their liquidity and tradability. You'll notice we omitted Fin Nifty and BankX because they're not liquid and you can't trade them, so no sense having them. Now that we've got our selection of key indexes sorted, it's time for our very first metric. We are starting with something foundational, and that's rate of change, or also known as ROC. It's simple yet incredibly intuitive and powerful. All that ROC tells us is the percentage movement either up or down of an index over a given time frame. We calculate this from one closing price to the next. So when you see 1 week change of say 5%, that signifies index climbed up 5% from its close last week to its close this Friday. The same logic holds for other time frames like 1 month, 3 month, and 6 month, and year to date. By comparing the latest weekly performance against longer periods, we gain a perspective on the index underlying mid and longer term trends. Now let's walk through the table to get more clarity. Let's take Nifty 50 as our first example. We'll start with YTD, which is year to date. That tells us how the index performed since January this year. The YTD number stands at 7.39%, and at 3 months change, you see 12.68%. And for the current week, it shows flat. What that means is Nifty as an index has seen a significant up move in the past 3 months. The year to date is also positive, but it's lesser than 3 months change because the index recovered from a drawdown. Now you may ask me, what is a drawdown? I'll come to that very soon. Let's look at Bank Nifty. Consistent greens, YTD is up 12.27%, all of which came in the past 3 months, while the last month has been positive and the current week again is flat. The third index, Mid Select, again we see a massive 19% up move in the past 3 months, slightly positive for the year and mildly negative this week. At a glance, ROC or rate of change tells us how each of these indexes have performed over the year and in recent past. But rate of change by itself does not tell us the whole story. It needs to be looked at in conjunction with what we call drawdown. And that's the reason we need to look at another metric, and that's called drawdowns. Now you may ask, what does drawdown even mean? And I know it's a bit of a complex concept, but stay with me. Let's say the market is at 100 at the beginning of this year. In the next few months, it goes up by 10% and becomes 110. And then it pulls back or comes down, there's mayhem, and the market is now at 105. Now, what the drawdown value tells us is precisely how much lower the market is right now compared to the peak or the highest point it was in the nearest past. In this example, the market has dropped from a high of 110 down to 105, and that's a drawdown of 5 points in terms of points, or roughly 4.5% in terms of percentage. Now, it essentially is measuring the fall from the high. Even if you're still overall in profits, you're in profits because you started at 100 and you are at 105. Now, extending this concept of drawdown, let's look at what is max drawdown. It's similar, but it's slightly different. Now, what we're trying to figure out in max drawdown is what is the maximum fall that an index has seen from its peak at any given point of time. In our case, we are looking at it from a YTD, year-to-date standpoint. So when we say max drawdown YTD, what that means is the biggest percentage or point decline the market has experienced in absolute terms anytime during the year. Let's take an example. Let's say the market went up by 10% and then there was a 5% fall. Now, after this 5% fall, the market went up 10% again. So which means, net the market is still positive. And from that new high, the market is now down, let's say 1%. Now, if we have to look at the max drawdown value, that will be 5% and not 1%, because in the entire period that we are looking at, the maximum fall that the market experienced was 5%. And as I said, it does not mean we are, net negative at the moment. All that it means is what is the maximum fall that, a given index or a product has experienced during this time. That's what max drawdown tells us. It's a very important metric to track because it helps us understand the possible risk in a given asset or an index. With that, let's move to the second metric of the day. It's one of my favorites and quite a fascinating one. You will soon know why. So what we would do is we would break the market move into two parts. One is overnight and one is intraday. Now, overnight is what happens after 3:30 all the way till 9:15. There could be events, global events, US, something may happen in the US. There could be release of some data, interest rates, all of that. A lot of things can happen overnight. And that feeds into the prices and causes what is known as a gap. The way we calculate that is current day open minus previous day close. That's what is a gap. So that's one segment of the market. The other segment of the market, let's call it intraday, is what happens during the day, which is from 9:15 all the way to 3:30. The market may go up or down, but that's one segment which is active and where markets are open. The previous one, markets are closed. So these are the two segments, overnight and intraday. So what we do for this particular metric is we add up the gaps which happen in the market as one series, and we add up all the intraday moves as another series. So we have two series parallelly running. One is adding up all the gaps which is going on. The other one is all the intraday moves which are happening. We add up that. So when we compare overnight versus intraday as two different data sets and look at them individually, we get some interesting insights. Traditionally, there's been something called an overnight drift which happens across indexes, not just in India, it happens globally. What that means is markets on an average tend to go up through gaps overnight, and during the day, they tend to mean revert or have a slight negative bias. Let's look at the data for the past 6 months in India. Now, if you would see that the month of Jan, Feb and March, overnight we had gaps. So that's why you see a positive value there, which is 2.4, 1.2, 2.2 and all of that. And intraday net it was negative, which means 2.8 negative, -6, -2.46 and so on. So what this tells us is during the first 3 months, the index was going up, Nifty in this particular case was going up overnight, and during the day it was going down. But something changed from April onwards. April was probably the bottom. So from April onwards, you saw the index going up not just through gaps but also during the day. For someone like me who observes this data a lot, this is some sort of a regime shift which is happening, and we'll have to watch it out as to till when it'll happen. It may revert back to its original form, that is, going up through gaps and, being mean reverting or slightly having a negative bias during the day. Now, why is this useful, you may ask? Well, if you find that an index is consistently making majority of its moves overnight, that tells you something crucial about where the edge lies as far as that index is concerned. Perhaps finding a way to play gaps is where the money is. Conversely, if you're looking at if there's a lot of action is happening intraday, then trading a range breakout is where the edge, maybe that's where the edge is. So it's important to understand how each index is moving, whether it's moving overnight or during the day, and then create a strategy based on that. That's when you have a robust strategy in place. Although we are not talking about stocks, a similar thing or a similar pattern plays out in stocks also. You have all the data with yourself, so you can always look it up. But I've seen it works in stocks as well, and it changes over time. So far, we covered rate of change, giving us that top view of how indexes are performing over different periods. Then we zoomed into overnight versus intraday contribution, which helps us understand where the market action is, whether it's happening through gaps or the action is during the day, intraday that is. With that, we come to the third metric, which is about volatility and the potential movement. I'll call it range. When we talk about range, we are going to look at the index or the asset from two perspectives. One is daily range and the other is a weekly range. So at its core, range is a very simple concept. So when we are talking about daily range, what we mean is the highest price of the day minus the lowest price of the day, or high minus low for a given day. And when we look at it on a weekly time frame, what that means is the highest price which the index or the asset touched during the week minus the lowest price. So only the time frames differ, but we are calculating how much did the index move. It could be during the day or it could be during the week. Now that we know how range as a metric is calculated and what these averages represent, you may ask, what do I do with this data? Well, the daily range or the average daily range is a simple proxy for volatility within the time frame it's calculated. For instance, if you are an intraday trader, the ADR, the average daily range, gives you a clear sense of how much the index could move during the day. So once we have that number handy, it has many uses. This insight is incredibly valuable for almost any intraday strategy that you may want to deploy. Now, you could use it to identify potential resistance, support levels. You can set targets based on, the strategy. But essentially, this tells you from open how much can the index move up or down. For example, let's take today the market opened at 25,500. Now, if the average daily range comes to 100 points, so from 25,500, we know at open, the market may go up 100 points or down 100 points. That's the possibility. And once you have that possibility in mind, you know the risk that you would want to take, you know the strategies that you may want to deploy. All of that comes later, but you have a good sense now how much can the market move. So in essence, you would know on an average how much does the market move once it's open. And knowing that is key as far as any strategy design, intraday strategy design is concerned. Whether you are a buyer in options or a seller in options, or you are a trend follower or a range breakout trader, either ways, knowing that this is how much an index moves during the day gives you a good sense of what to expect from the markets. Also, if you are an options trader, you will observe that range over long periods of times correlates very well with other volatility metrics that you may use. It could be VIX, it could be implied volatility. But there's a key difference. Range is what has happened in reality. It's kind of the realized price move, whereas IB and VIX, they typically price in markets' expectations in terms of what could happen. There could be some lead or lag between them, but nonetheless, range is a very good proxy for volatility. During high volatility, you would see range to be high, and during low volatility, range would be low. With that, we are 3 down, rate of change, overnight versus intraday contribution, and range. At this point, you may want to get some coffee. I'm going to get some for myself. Our next metric is indeed related to the concept of range that we just discussed, but it's quite interesting by itself, especially if you are an options trader. Fair warning, this metric may seem a tad bit complex at first glance for those who are completely new to options. We're going to talk about straddle price. A quick disclaimer, I am not going to explain what a straddle is. Zerodha Varsity and Sensible both have done some great content explaining what it is. I'll make sure that I'll link some of that content in the show notes. You may want to go through it if you're new to options. Now I'm going to talk about what a straddle price tells us. It's similar to range, but there is an important distinction. Let's walk through the table to understand it better. As you can see, we have the names of the indexes and their closing prices, DTE, which is days to expiry expressed as calendar days, straddle price, and also straddle price as a percentage of spot. Now let's take an example to understand it better. Let's say Nifty is at 25,500 and we are 4 calendar days away from expiry, which means we are at 4 DTE, days to expiry, and the straddle price, that is the combined premium of both the ATM strikes, that is at the money call and put, is at 200. What that means is there is a 68% chance that the index will close within the range of plus or minus 200 from 25,500. Remember, straddle price is about future expected close and range is about high and low boundaries that have happened in the past. Now, you may again ask me, all of that is okay, Sandeep, but what do I do with this? Straddle premiums tell us how the options market is pricing the expected move and the possible range within which the index will close on the day of expiry. And the range tells us how much on an average does an index move in a day or in a week. When we combine them, we get a sense of both the expected boundaries of the index move and the expected close. Just remember, all of this is just an estimate, an approximation, not a guarantee, and please don't come after me if the range goes beyond what the straddle estimated or the average range. Markets are known to surprise. So with that, we are down 4 metrics, and I feel like saying the way ChatGPT does, oh, you're doing well, keep it going, sounds so fake, no? But anyways, let's move on to the next metric. Now, this metric gives us a sense, a macro sense rather, of what's driving the markets at a given point of time. Especially useful if you're trading stocks, and even if you are not, it's good to know what's driving the market. Let's call it sector and market cap performance. You see, NSE has got some 17 listed sectoral indexes and 18 market cap based indexes. Now, for those who are new to this, NSE organizes sectors into various categories. We have roughly 17 of them. Think about everything from FMCG to IT to banking. And then there are 18 market capitalization based indexes, which are grouped by their size, that is large cap, mid cap, small cap, and all of that. You'll find all of this on niftyindices.com. I'll link it in the show notes. A quick heads up before we move to the visuals. The charts and the graphics you're about to see won't feature every single index. The main goal here isn't to be exhaustive, but to illustrate a powerful method you can use for your own market tracking. So let's get to the tracker and understand what we should be looking at when analyzing these sectors and market cap indexes. We'll look at these indexes from 3 different lenses: performance, consistency, and dropouts. On the left, under this week's section, you will see the top ranking sectoral indexes this week. So that's performance, ROC. Coming to consistency, we need to ask a few questions. 1, were they in the top list last week as well? Blue color tells us that. Perhaps if it's there, then it's a new trend is emerging. Are they new entrants this week? Green color tells us that, which means they've just shown up this week. And then lastly, were they consistently there all through the past 4 weeks? That is yellow color, and that tells maybe there's a consistent trend developing. Lastly, we look at dropouts, that is which sectors got dropped out of the ranking this week compared to last. They are colored in red, helps you watch out for a waning trend perhaps. The logic remains the same when it comes to market cap based indexes as well. The real magic, I think, happens when we combine these 2 views. Let's say the top sectors this week are Nifty FMCG, Nifty FinService, and Bank Nifty. And the top market cap based indexes this week are Nifty Next 50, Nifty 100 and Nifty 50. Now, what does this tell us about the broader market? I think it gives us a useful lens to look at both sectoral and market cap performance separately. For example, if Nifty FMCG is doing well, drill down on the index and see which stocks are performing well in that index. Similarly, if Nifty Next 50 is performing well, look at opportunities from Nifty Next 50 index stocks. The idea is to observe which sectors and which segments of the market cap spectrum are leading. And if you are an equities focused trader, you can narrow down your stock selection accordingly. Hope that gives you something to think about. With that, we come to the last of the metrics for this video, but in a way, the most important one. Let's call it directional bias. As traders, ultimately it boils down to one fundamental question, right? That is, should I be looking to go long on a given index or should I be looking to go short? This particular metric is going to help you with that, and that's why we call it a directional bias. We assess this bias using two key reference prices based on moving averages. Now, don't worry, I'm not going to get into a deep technical explanation of what moving averages and how they're calculated. There are tons of fantastic resources on YouTube, and you can, learn it by yourself. And it's fairly simple. But essentially, think of moving averages as dynamic reference lines which keep adapting to price, and they sort of tell us the average fair value for an index over a specific period of time. For our context, what we are going to do is we'll use two moving average look back periods. One is a 21 period EMA and the other one is a 50 period EMA. And that would tell us, be it on a short-term time frame or a medium-term time frame, whether a given index or an asset is uptrending or downtrending. If the current price of an asset or an index is above the moving average, it means it's uptrending and that has a positive bias. And the opposite for if it's below the moving average, it means it is downtrending and has a negative bias. Now, before we dive into specific indexes and the trends in our table, a very important fair warning. This is not a trading signal on its own. Just because an index is above a moving average does not automatically mean that you should go long on that or buy that index. Likewise for going short. Actually, short has got a different story by itself. I'll tell you more as we move on. Now, what we are attempting to do here is simply get a broad directional sense and understanding of the direction of the wind, so to speak. As some of my friends in Hindi would say, hawa ka rukh kis taraf hai, when they ask, So that's what we are trying to find. This is not a trading system by itself. Now, if you look at the table, you'll see we've taken two specific moving averages, which I spoke about earlier, 21 period and a 50 period. 21 period tells us about short-term bias, 50 period is a good moving average look back for a medium-term bias. Now, both these are calculated on the basis of daily closing prices, and here's how we can interpret them. If the current day's close price is above both the 21 period and 50 period moving average, we call that a strong uptrend. That's where we are right now as we speak. If the price is below the short-term moving average, which is 21 period, but still above the 50 period moving average, what that tells us is that the index is in an uptrend, but it's a bit muted or it's kind of consolidating. It might be pulling back as well. So a larger move upward is quite possible. And finally, if the price is below both the moving averages, it's definitely a downtrend and the bias is clearly negative. It's also really important to note, especially in markets like ours in India, indexes generally have a positive drift over long periods of time. And that's one reason going short and making money out of going short is quite tough. And net, you would have seen it yourself, markets tend to go up more often than not. And that's why if it comes to betting on a direction, it's better to bet on the upside rather than on the downside. So that brings us to the end of this video on key market metrics. What we've covered is 6 key market metrics that you should track weekly. They are rate of change, overnight versus intraday contribution, range or average daily range and weekly range, straddle price of options of a given index, sector and market cap based performance, week on week, And finally, the directional bias of a given index. As a bonus, to make your life easy, I've created a tracker where you can find these metrics updated week after week. I'll make sure that I put that in the show notes. And remember that analogy of observing the park or the forest from your window? Well, consistently tracking market metrics will give you that same sense of markets shifting seasons. There are seasons in markets as well, Over time, you will see that there are times, let's call it spring, where there are opportunities, and then there are times you might as well carry an umbrella because you never know what happens. On that note, thank you for watching. I hope you found this useful and I look forward to see you more often. Do comment and let us know if you liked what I had to share, and if you have any questions, feel free to ask in the comments. I'll try my best to answer. And lastly, don't forget to subscribe to this channel. Ciao!